Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to cover the EIA data that just came out, and then some other things that have happened. Obviously, if anybody is focusing on the shipping market, the crude market, everyone knows about the Suez Canal, and we're going to just talk briefly what does that mean. And then we're going to look at what does the physical market continue to tell us. So we're going to break it down into our normal segments of the overview, a deep dive into refined products, and then looking globally, especially in obviously that bigger linchpin of the physical market. So, before we get into it, we just like to remind you, please like, share, subscribe. Your support is appreciated. And then as always, we just want to rehash the fact that we have no agenda. Right now we just show you the data sets and the data points that we believe is viable and really the key driver for what is going to happen in the foreseeable future. And that's why we've seen some disconnects obviously between the paper market and the physical market. We saw some of that correct over the last few days. So these are things that we always like to look at when we're trying to consider what does the holistic view of that market entail. So getting into the Suez logjam, you can see right where the ship is stuck. I think everybody has seen some fun videos of Austin Powers, going back and forth in the corridor, and it's something similar where it's just stuck, blocking traffic on both sides. And just what is the Suez Canal? So it's obviously a big thoroughfare. It sees about 30% of trade, just in general, and then just some economics of it. So the Suez Canal is the most trafficked waterway. And then it sees tankers and everything else in terms of what really happens on a holistic basis, with 12% of global trade, 8% of LNG, and about 1 million barrels of oil each day. So if you consider how long it's been shut down, there's obviously going to be that log jam that you can see where the jams are happening on both sides, which will impact things to a smaller extent. But again, as they've been talking about refloating it, because when you look at it, it's stuck on both sides. So they have to refloat it and then turn it back so that it continue going forward. So this is something that will clear over the next 48 hours, but 1 million barrels of oil each day. So you're talking about 3-4 million barrels of oil that's going to be behind. And then just where is that in terms of the log jam is going to just kind of delay some of that. But again, these are short-term issues that will be corrected over the near term. But then when we just look at the EIA world oil demand outlook, you can kind of see where they see us getting back to normal, which if you just take away that original forecast and then look at kind of where we sit, it's realistically on a 2022 basis. And they're also pairing that against the IMF economic outlook. And when we look at the economic outlook, that's something that we continue to talk about. And as we keep indicating how things continue to soften on the GDP level, we've had a renewed case of lockdowns in Europe. We have an increase in India. Now Mumbai has put up one of the biggest increases to date. And these are things that are just, even if they don't have a stringency index increase or they don't force people to stay home, the consumer is just going to change behaviors to mitigate against exposure. So that's where some of those issues that will come to play when we look at fuel demand, and then how is that residual going to look over time. Now this is something that we're going to talk about more in the economy show, but I thought it was an interesting chart looking at the sovereign spread. So what has happened at the fixed income level as oil prices have gone up. And this is something that we like to look at, where when you talk about the spreads and how rates have started to go up, that yield curve has shifted. We've seen the issues with Russia that were really fed off of Turkey after they had their big issue of the Fed governor, not Fed, but central bank governor getting fired. Then you had that huge increase in terms of Turkey spreads. Russia had to pull the bond offering. Their central bank has been trying to be a bit more active to try to keep some of that monetary easing out there. But they've actually had a surprise increase in rates, which surprise is relative, because if you looked at the ruble, if you looked at what was happening in spreads, that's so surprise is a relative term because the market was already starting to price that in. We've seen issues in Brazil continuing. So this is something where we think the spread is going to continue to drift higher and much closer to this to the average curve. As we think, crude prices are obviously a bit too high, that'll start shifting down and to the right as it moves up that curve on the EM spread side. So this is going to be something to watch, because as we did something yesterday on Twitter, and we're going to talk about it again more in the econ show, the inflation side, the spread side is going to be an overhang, especially when you consider fiscal and monetary easing. Now, one of the big things that we wanted to talk about ahead of time is the big increase in Chinese crude oil inventory, which we've been talking about, but now we're starting to get a bit more data sets and data points on that. And when we look at the Ursa space system, they're saying that the crude inventories are back to a near peak. And what does that mean? So inventories, according to them, were at about 953 million barrels in the weekend of March 18th, or 69% of capacity, with the highest being reached of 73%. Inventories in the Shandong province, which we talk about each week, is at 67.5% of capacity, or it's the highest level that they have calculated. There has been a little bit higher, but they calculate going back to 2017, and the highest was surprisingly in 2016, 2015. So that's why for them it's a little bit higher. But when you consider just where things are in general, we're seeing a big increase in Chinese storage. We're seeing that residual go down into ESPO pricing, which we'll talk about, how there's a lot of these spare cargoes in that physical market. And then obviously we have those issues that have been created, from the freeze off, where you can see polypropylene, PVC pricing has continued to push higher. This is something that we're going to talk about when we start looking at the LPG and the propane side, but it's important to understand that there has been that increase in just poly, PVC, obviously PVC, poly, big pieces to the housing bubble, the housing boom. So there's a lot of not only just supply issue, but also that demand push, which is supporting prices right here. Now, when we think about what is happening on spare capacity or capacity rising, we've heard from Saudi Arabia and Kuwait talk about increasing the neutral zone to 300,000 barrels a day. We know the UAE still is sitting on a significant amount. They've had a new oil find that they've talked about. Iraq has been investing with the help of Russia along some very specific locations along the border between Iraq and Iran. And these are things that they continue to want to work on. And Libya has now officially appointed the oil minister. They're getting a huge increase in spending as they're getting the lion's share of the budget to really kind of pick up some of their biggest, obviously, revenue drivers. So that's where you're seeing some of that push on the back end. And Iran is just that wide unknown. Now, before we get into the U.S. side, we just wanted to look at Canada because we continue to see our imports remain elevated. Canada continues to set those records after peaking, and it's really coming from the fact that we are net short heavy crude in the global market. And this is something that is going to be a supporting nature when we start getting more specific into crude quality and what does that mean for Canada as we continue to pull more into the U.S. Now, when we look at what's happening with WTI futures, you can see that we've started to pare back. The orange is where we currently sit. So we've seen some pullback in the front month. The curve has shifted down, but not to the same level when you get further out into 2023. You can still hedge, above 55, or we're still priced above 55 through September of 2022. So still over a year in terms of where some of that support is. And then we don't start to dip below 50 until we get to 2025. And not that anybody's out there hedging at those levels. And again, this is just looking at the shape of the curve, what is expected, because there is that spare capacity sitting offline right now. And Saudi Arabia has been talking about maintaining some of this cut, just given some of the issues that we continue to see in the underlying physical market. And that all leads to what is happening in the U.S. And here you can see that we did have a crude build. It was a build of about 1.91 million barrels. And the lion's share was obviously was brought by PADD 3 with an increase of about 5.38 million. We did have draws out of pad 2, pad 4, and pad 5, but it's going to be interesting as we see, we picked up essentially that last remaining piece of production that was missed with the freeze off. So now we're back to about 11 million barrels a day. We have an exit rate of about 11.3, just given, the amount of activity that's coming through. But what we're seeing here is an increase in imports as refinery utilization increases, but a big hit to exports, which is what we've been talking about, again, coming to the issues in the physical market when we consider exports from the U.S. into Europe and into Asia continue to come under pressure, especially at the current spreads, which is why we're going to continue to see some of these builds more so than we should as refinery throughput remains depressed. You have a steady increase in production, or at least production holding flat. And then we do have more imports coming through. So this is just looking at where stockpiles, so this is as of week on week. So stockpiles rose about 7.7 million barrels according to these different locations. As we look at land storage, we'll go through offshore storage in the third segment. And you can see how quick we had that reversal. And we keep talking about it and we keep trying to drive it home. There's a seasonal aspect to all of this where we're supposed to draw during some different periods in different locations, but now we're starting to see some of these increases. And Saudi Arabia keeps talking about the 5-year average, but if you think about when we had a huge increase in storage, it was from the end of 2014 through 2015 into 2016. So we're already using an elevated number. So what is the right number to use? But that's where we're just looking at the way the market is talking about it. And you can see that there is on the land storage in total, we continue to push towards the top of that 5-year cloud, pushing back above, I think when you talk or listen to Saudi Arabia, this is what they're looking at when they're, talking about, or at least mulling the chance of increasing some of this production cut because they have maintained their exports. So what is doing that? Here you can see the road fuel demand. China is right back to normal for the most part, but rest of Asia is starting to pull back as we have an increase in cases in India, and we have some residual in other parts of Southeast Asia. Europe is on the downtrend again. Again, it's not going to move to the same low as it has in previous previous months, just because there's a certain amount of pushback, as we saw in Germany, when they were going to have some very aggressive Easter restrictions, and that has now been pulled back a bit. But we did get a mass exodus from Paris and other parts of France, and they are talking about going into another 3 sections, going into a lockdown. So again, Europe is going to have that overhang, where North America is sitting at that depressed level, with a small increase in general as we look at spring break and Easter break, as Easter is early this year, as we see April, I think it's April 4th. So we will start to see some additional driving as we go into the first week of April. Now, when we look at some of those export sides, Chinese exports increased on the gasoline side, and you can see that they're setting a new seasonally adjusted all-time high as that demand remains, capped internally, and they do have a big increase in that internal storage, which is what they're trying to push into the market to try to balance it. So this is something that remains a overhang for those levels when we consider about the movements of global refined products. And we're seeing something similar on the diesel side as we see those headwinds within China as they talk about kind of slowing some of the stimulus, trying to normalize, which we'll talk about in the Econ segment 5. And it's, again, this is just putting more product into the world, because yes, they have increased oil imports, but they've also increased refined product exports, which, as we've talked about previously, Australia is shutting down facilities. We have record low or near record low refinery throughput in South Korea, Japan, Malaysia, Indonesia, and obviously parts of Europe. And this is all culminating to just a shift in supply chain. So even though they're cutting, or I should say in this case, China, they're increasing oil imports, they're also increasing exports, which is decreasing refinery throughput elsewhere, decreasing their oil throughput, decreasing their total refined product exports, and realistically not so much tightening the market, but shifting just the supply chain in general. So then when we start looking at what is happening in the U.S., you can see that we've had a steady increase in builds. This is one where obviously we had the freeze off and we're trending back towards that high. But when we take it against the 5-year average, the U.S. is 26.1 million over the 5-year. 47.3 over the year over year. So again, we're still at that elevated level with some more headwinds in general as we have gotten a bit back to the normal refinery utilization rate, and it's really being driven by the record highs that continue to push on a seasonal level into Pad 3, sending this to the new setup as Cushing, with additional refinery throughput, Cushing is continuing to drain down into Pad 3. But again, it's just the pace that is going to be the problem as we do have activity increasing. And just when we look at Cushing, Cushing is still 7 million barrels over the year over year, but now 4 million barrels below the 5-year average. So it's still holding pretty close to where it should be at this point in time. And then when we look at imports, here you can see the increase in imports of 299,000 barrels. It was driven by Pad 1, Pad 2, Pad 3, and Pad 4. Pad 3 is going to continue to see that increase, but the one that we think is going to see the biggest adjustment is going to be Pad 5, while Pad 1 continues to hold fairly stable at these levels. But when we look at the year over year, you can see that Pad 3 obviously continues to see that depression in Pad 5 as well. Pad 5 will start to adjust that, and Pad 5 being the West Coast, as we have more driving, that is where we've seen the most recent increase in mobility, which again is going to increase this activity in general, and that you'll see more of the imports coming through. And that's going to pull through more refinery throughput. So when we look at where we are right now at 81.6% utilization rate, that's an increase of 5.5%. We still think 83% is kind of the right number in general, now that we are coming fully into that turnaround season, or what turnaround levels normally should look like at least at the lower end. But when we look at just that activity, you can see Pad 3 and Pad 5 are really that driving force, and that's going to continue to be the case where we think we're going to see additional activity in those two locations, which will just keep that import level coming through. And why not, given the pricing in the market? Now, when we look at implied demand, as we've been saying, the implied demand was going to remain lackluster, especially when you start factoring in some of that activity in general. So when we look at gasoline had an increase of 174,000 barrels to about 8.6. We think there is more upside to that, especially as we go into Easter break, getting closer to 8.8, 8.9. But again, it's going to be that seasonal move. We always get a move in the spring, and here we are. And the problem is we're getting the move in the spring, but it's adjusted lower even against those seasonal norms. Distillate was down by 436,000 barrels. That again comes down to that heating oil side, as we do have that warm up. Jet fuel had a small increase of 27,000 barrels a day, still hanging around kind of that target that we have, that call it 850 to about 1.1. And it's not something that we see changing all that much, and we'll get to that in the second segment. And then we have propane, which will continue to see that stable move higher, just as we get those increases over the year and 5-year, just because we have that demand and the pricing is there on the polypropylene side. When we look at floating storage, so floating storage has started to come on shore. We did get that increase. Just given where the Suez hits, this could come further down. This, it's just going to be a matter of the timing delays coming through. But this is something that is going to continue to move further down and just move closer to that bottom, or maintain the bottom of the cloud. Then when we look at imports, here you can see the imports started to increase. We're still well off of the normal. And even though we're going to continue to see some of that ramp up closer to that 83% utilization rate, it's not going to be enough to put us to the average, and we're just going to suck around the bottom of that cloud. Then when we look at the oil imports, you can see that, as we were saying, we're just going to continue to track the 5-year average. And here we are almost on point to the 5-year. Now, as we go forward, it's something where we think that we're going to shift back up. and we're going to actually outpace the 5-year average and again still maintain on over the next let's call it the next 12 months. We're still going to maintain above the 5-year average, but it's just when you think about the those movements, so the next move will be up in general as we look at that rolling 4 month 4 week. There we go. So then when we look at the overall opportunity on the utilization side, you can see that we're now back to the low end of that utilization rate after recovering from the freeze off. We're still not back to where we were prior to the freeze off, but we really shouldn't be, just given there is a certain amount of seasonality. Some of the refiners will take the opportunity to keep things down a bit longer, just to do some turnaround work and some extra work, just given that they have the capacity at this point. And it's where we continue to see a little bit of an increase closer to 83%. But when we look at that 29-year average, you can see that we normally see a pretty steady increase in activity over the next few really months at this point, as we run or start to increase into that summer driving season and summer demand, which is those peaks. So when we think of shoulder season is spring and fall, and high demand season is winter and summer. So obviously winter with heating oil, heating demands, summer with driving demand. So here's where we're going to continue to see some of that movement. So it's just, we don't think there's going to be enough activity to really show that they should be anything above, call it 85 to 87%. Just given the amount of available cargoes of refined product in the global market. But again, those are things that we're going to talk about in a bit more depth in segment 2 and segment 3.